Good day, everyone. Today is our second week of class for the subject Fundamentals of Accountancy, Business, and Management 2. And now we are going to discuss another topic. And our topic for today is all about basic documents and transactions related to bank deposits. But before that, let me first read to you the objectives. So at the end of this module, you are expected to identify the types of bank accounts normally maintained by a business. Differentiate a savings account from a current or checking account. Prepare bank deposit and withdrawal slips. Identify and prepare checks and identify and understand the contents of a bank statement. So, basic documents and transactions related to bank deposit. So our topic is all about bank deposits. So bank deposits consist of money placed into banking institutions for safekeeping. So these deposits are made to deposit accounts such as saving accounts, checking accounts, and money market accounts. So the account holder has the right to withdraw deposited funds as set forth in the terms and conditions governing the account agreement. So the deposit itself is a liability owed by the bank to the depositor. And bank deposits refer to this liability rather than to the actual funds that have been deposited. So when someone opens a bank account and make a cash deposit, he surrenders the legal title to the cash and it become an asset of the bank. In turn, the account is a liability to the bank. So there are several different types of deposit accounts, including the current accounts, saving accounts, call deposit accounts, money market accounts, and certificates of deposit or CDs. So we have here businesses that usually maintain. So they have two types of accounts. We have the savings and the checking or current account. So when you say savings, these are intended to provide an incentive for the depositor to save money. The depositor can make deposits and withdrawals using the form provided by the bank. Banks usually pay an interest rate that is higher than a checking account or a current account. And then some savings accounts have a passbook, so in which transactions are logged in a small booklet that the depositor keep. And then some savings accounts charge a fee if the balance falls below a specified minimum. Next is what we call the checking or the current account. So in current accounts, money held under a checking account can be withdrawn through issuance of a check. So banks usually allow numerous withdrawals and unlimited deposits under this type of account. So the interest rate for checking accounts is usually lower as compared to a savings account. So the account holder or depositor of a checking account is normally provided at the end of the month. So a bank statement showing all the deposits made, checks paid by the bank, and the balance of the account. So the depositor is given easy access to the funds as compared to a savings account. So when you say time deposit account or a certificate of deposit account, which is a type of savings account that is held for a fixed term and can be withdrawn only after the lapse of the agreed period and by giving notice to the bank. So the account may be withdrawn also anytime. However, the bank usually charges penalties. This type of account yields high interest. We have also another type of savings account that is popularly used nowadays. So it is an ATM or the automated teller machine, wherein you can withdraw that can be made through designated machines. So this is a 24-hour teller machine and the funds can be withdrawn anytime. So the advantage of this account is that even if the banks are closed, you can withdraw your funds In order to open an account, the bank will require individuals certain documents such as valid identification cards and will ask you to fill up the forms prepared by the bank. So upon approval of the application to open an account, the bank will give the depositor's account number. So on the preparation of a bank deposit and withdrawal slips. A withdrawal slip and deposit slip are written orders to the bank. These slips are used to take out money or to put in money to the depositor's account. And then when you say withdrawal slip, without a withdrawal slip, the bank will not allow you to get money from your account. Just to make sure that it's really yours. That's the purpose of a withdrawal slip. So the required information in the withdrawal slip are the account name, or when you say account name, it's the name of the depositor. Account number is the unique identifier given by the bank for every account maintained. We also have the date of the withdrawal, the type of account, if it's a savings or current, and then currency. So amount to be withdrawn, the amount that depositor wishes to withdraw from his account, and also signature of the depositor. So this is the most important part in the withdrawal slip. Without the signature, you cannot withdraw. So the signature is a proof that the depositor is authorizing the bank to get money from the account. So there are instances that the depositor cannot attend personally to withdraw the funds. So he may authorize a representative by indicating the name of the representative in the space provided, and the representative must sign. So there is a need for the representative to bring valid identification card upon withdrawal, otherwise the bank will not approve the withdrawal. So, deposit slip. So, the bank provides us deposit slip that the depositor will fill up every time the depositor puts in money to this account. So, they usually require information in a deposit slip. So, syempre, di mawawala yung account name, yung account number, date of deposit, type of account, yung currency, of course. And then, ito yung sample ng bank withdrawal slip and then bank deposit slip. So, kung magwi-withdraw, ang gamitin is yung bank withdrawal slip. And then, pag mag-deposit, of course, ang gamitin is yung bank deposit slip. Check. A document that orders a bank to pay a specific amount of money from a person's account to the person in whose name the check has been issued. So, this is an example of a check. Of course, di mawawala yung payee, yung payer, and then there's also, you can see there, remittance advice. Next is, the following are the parties involved in the transaction that uses check as medium of exchange. We have the drawer. So, yung drawer is the person or entity who makes the check. The payee is the recipient of the money. And then drawee is the bank or other financial institution where the check can be presented for payment. So, this is how it looks like the bank statement. Okay, you can see there the name of the bank owner or the account name, the current account number, the statement period. We have there the check number, transaction code, the debit, the credit, and also the balance. So the date column indicates the date transaction was made. Then the check number indicates the details of the check paid by the bank, and then the transaction code is normally a bank code for the transactions. The debit column represents all charges or deductions made by the bank to your account, and then the credit column represents the deposits or additions to your account. So that was made by the bank. Then the balance column is the running balance after considering the effect of the transaction to your account. So we have here samples of debit transaction. So first is the bank service charge. So this is monthly fee charged by the bank for its services. Example of this is cost of printing checks, writing funds to other locations, and other fees. We have NSF, the not sufficient fund also. We have another sample, but for under the credit transactions. So we have the collection of cash proceeds from notes receivables and interest income earned by the deposit. So as part of control, the bank statement received from the bank is compared with the accounting records of the business. So this process is called bank reconciliation. So bank reconciliation will be discussed in the succeeding chapters. So together with the bank statements, the banks will include the copies of checks cleared or paid. So issuance of check, we have the cross check, we have the stale check. So there are also kinds of checks. We have the customer's check. So customer's check is the checks received from customers. So these are usually issued as payment for the inventories and services that they have received from the entity. And then when you say traveler's check, this checks with a security feature. So upon receipt of the traveler's check, the payee should immediately sign the traveler's check. Before the payee can make use of such check, the payee must sign the same check again. Next is we have the manager's check. So this check issued by the bank manager. So this is a guarantee by the bank that the holder of the check has the necessary funds deposited in their financial institution. And then cashier's check. So this is check issued by the bank's cashiers, and also we also have the company's undelivered check. So this checks prepared company that will be delivered to corporate creditors or suppliers. So if the checks are not yet delivered to creditors or suppliers, the amount indicated in the checks are still considered as part cash balance of the issuing company. And of course, the last one, we have the last two. We have company's post-dated check. So a company check already delivered to the payee, but it cannot be encashed or deposited yet because the date indicated in the check has not yet arrived. And so for example, if the check dated January 22, 2016 and then was issued on December 31, 2015, the said check is post-dated. Next is the last one, we have the company's stale checks. So checks are issued to by the company to suppliers and creditors and not in cash on time. So payees like suppliers and creditors are often given 6 months from the date of the check to encash it. So if the checks are not yet encashed after the month period, then the checks will be considered stale checks and no longer be accepted by the bank. And then, however, the liability of the company to the creditors will remain. And then the creditor will just request for another check from the company as replacement. So as long as the replacement check has not yet been issued, the amount indicated in the company's stale check will be considered as part of the cash balance. And this is since the company still maintains control over the amount. So that could be all for our lesson for the second week. And we are going to continue this one next meeting. Thank you and goodbye.